Hi, everyone. I'm Cullen Haynes, and welcome to Lawyer Lending Live. My next guest, I'm sure needs no introduction. Very good friend of mine. I've known him for the last 4 years, has a total of 17 properties and has been invested in property for well over 7 years. Can you please make very welcome my dear friend, Arjun Paliwal, Director and Head of Research at InvestorKit. How are you, Arjun? What is happening, my friend?
My friend, it's great to be on this show with you, and I'm very, very well. I'm here in the city of Adelaide today, networking, continue to build relationships, and having a lovely Melbourne Cup event that we had yesterday, actually. So that was a lot of good fun.
Oh, the Melbourne Cup. Did you back any winners, mon ami? Did you back any winners?
Unfortunately, I didn't, but some of our team members did. So we're pretty stoked for them nonetheless.
Very good, very good. The race that stops the nation and whatnot, as it were.
That's the
But
one.
nonetheless, mate, what is happening in your world professionally? Tell me, give me the pulse check. InvestorKit, what is happening?
Well, InvestorKit's been going through a growth phase, really. So from a professional sense, a year and a half ago, there was a team of 3 at InvestorKit, and now we've got over 15 team members, and it's been
Wow.
a lot of growing. But this growth has come off the back of obviously a high level of demand from our clients, and that's from repeats, word of mouth, close industry relationships. And so I feel just having all of that come together, even amongst slowing global economic periods, is a key sign that just represents a healthy forward-moving business. So that's one thing I'm very grateful for, and I guess that's kind of the big highlight for a professional sense.
So it seems to me, and we'll get into it in a moment, that InvestorKit seems to be a very contrarian business and seems to do well when times are tough. Would you not agree? Am I not putting words in your mouth, mon ami?
Look, that's a fair way to say it. I guess we seem to hold our own internal economy, and that's driven by how a business within our own economy looks after our clients, and that, of course, turns up and turns into more.
Absolutely. So let me ask this question because we've got a few viewers on the stream right now. May I just say, please put your questions. It is now 2:26 in Sydney on the 2nd of November, and I know it's 1:56 in Adelaide, my hometown. Please put your questions in real time, and we'll endeavor to ask Arjun anything you like property related. But is it too late to buy, Arjun? Is my question?
It's not. Like, the key here is that it's all dependent on you and your personal plan. I've looked at property buying for not only myself many times over, but hundreds and hundreds of millions of dollars for clients, as well as many investors that we've worked with, and the stories we hear of what works well and what doesn't. And I've been able to, kind of reviewing all this, come to a point to say that there are 3 distinct journeys in property investing. One is acquiring, the second is holding and optimizing, and then the third is consolidating. And I find the bigger the person can acquire in the shortest period of time means that you need less percentages of growth to create a greater compounding effect. And that's quite important. So let me just repeat that. The person who can buy the most in the least amount of time, right? Now, if we are having the buying the most the least amount of time, what good does a time period then do for you in terms of a good or bad time? And this concept is extremely important, because if we get our holdings to a $5 million portfolio, to generate 500K in capital growth, we need 10%. But a $2.5 million portfolio needs to see 20% to generate that same amount. So the key here is that the overall asset base you build in the shortest period of time gives you the largest moving compounding figure. And so that's why one doesn't need to look at time. And this is where we move on to those other steps of holding and consolidating. If you've got more assets in your portfolio, Cullen, and you look down 5 years later, 20 years later, and you start consolidating them, well, when you start selling a property, you don't want to sell the only one you have. Otherwise, there's no income stream created. So it needs you to
Correct.
buy multiple
Cash
to
flow,
sell.
baby.
That's right.
So, because a lot of my clients are lawyers, as you know, and a lot of tuning in, that's obviously a great strategy, but it's very there's a lot of risk involved in taking on that much debt if you need to debt finance it. What's your argument, or what's your because I know some of our clients have used both of our services 6, 7, 8 times doing the strategy that you're talking about. How do you guide them through that question of, is it a greater risk onboarding all these properties with debt attached?
Yeah, so there's mechanisms we'll put into place to minimize risk. Firstly, the risk of you buying one property and not buying any property, they both have their own risks in their own respective rights, right? One is seeing money print away, inflation go away, and continue to impact you whilst you don't have debt that works for you or asset prices that work for you. And then the other is mismanaged debt that you don't handle so well, and obviously it comes back to bite you. I think when we think of mechanisms, and especially like many of the clients that we've worked with together who've bought 5+, 6+ properties using our services, I found something quite consistent. Number one was they kept a group of buffers, right? We didn't go from 1 to 2 to 3 just blindly. We knew that there was a cash buffer there sitting there as we went across it all. Number two is we bought with a balance of purchase price for affordability, capital growth prospects, and rental vacancy. So when the rental vacancy remains quite tight, the core risk that someone has to holding on a property is either lots of maintenance or either lots of vacancy. Otherwise, very few people feel the need to have to simply sell a property just because it hasn't had the same level of performance maybe thereafter. But most people will actually hold on to a property if it's not causing rental or maintenance issues. And then from there, if we move on to diversifying across the country, there are increases in their chances to see a growth period somewhere in their property portfolio at that given time. And so when you have risk measuring mechanisms like this and you protect yourself, then it actually can reduce risk the more you have. And it's not so much a game of less is more, because the truth is more in property investing. You think less about certain market performance as you're spread across more cities. You think less about the deposit you need to save. You can keep those savings for your own buffer because you're using equity to buy more. And then all of these things coming together when you think of affordable properties or those that have good rental yields and tight rental vacancies, it's also quite easy to hold the asset too. So it is a situation of more is more, not less is more in this space. And that's how I found it's actually less risky the more you have.
Interesting. Well, a testament, 17 properties yourself. What's hot right now, Arjun, and what's not, would you say?
Yeah, good question. So in the short-term metrics of things, the majority of cities across Australia are seeing a change in certain trends. Number one trend is sales volume, which means that the demand side, people buying and actually transacting. That is reducing, coming off its peak from, I'd say, between Feb and June this year. Different cities saw different peaks. Some still rising, but the majority of Australia came off its peak earlier this year. So that's a sign of some slowing trends in demand. What was interesting, though, is days on market, the time it takes to actually see those transactions happen is still extremely quick and still remains quite healthy for most parts of Australia. So it hasn't made a turnaround like most would think. In terms of prices, we are seeing, depending on which data set you take, anywhere between half to 2/3 of most house markets on the slowing side. So when it comes to what's hot, it's not 100% slowing or declining. It is still half to 2/3, depending on which data set you look at. So that means there's still a group of markets. And the group of markets, we're seeing certain characteristics. One, affordability, that more affordable side of markets. Like even in Sydney, you've got the southwest of Sydney that has remained quite resilient to some of these changes. Number two, in terms of affordability, is the undersupplied component of it. Yes, the sales volumes piece has dropped off, but there are many cities, like I'll give you, Adelaide still remains substantially below pre-COVID averages for listings for sale. And then we also have markets like Toowoomba, Bundaberg, Townsville, Rockhampton, Albury, Wodonga. Many of these cities still have below the hometowns repping. Yeah, many of these cities still have a listing level well below their pre-COVID numbers. There are some locations like Brisbane where they had a phenomenal growth run and their listing levels have spiked substantially, but they still remain quite low in the sense of from a pre-COVID level. So I think right now a few cities to look at are ones that bring affordability. Second, that brings also a very low supply level in comparison to pre-COVID averages. And third is tracking certain sales volumes. we are seeing certain markets, like some of the ones I've mentioned, still maintain healthy sales volumes, which in turn is keeping 0.5% to 1% capital growth rates per month. And when you analyze that, that is very much above average and even a boom territory in some locations that are still happening. But the majority of locations in Australia, especially with changes on the macro pieces, have seen, their sales volumes decline from peak. And that's
Of
okay.
course.
We shouldn't be seeing those levels of 20% growth every single year.
No. So are you in there's that old cliched hackneyed, it's time in the market, not timing the market. Is that true?
It's a bit of both. You know what I mean? It's time in the market is your cure to solve it all. The time in the market is to make sure you reduce opportunity cost. That's where professionals can be on your team to do both. But if you want to look at it from a measured worst case scenario, then yes, 90% of local government areas achieved 5% compound growth rates or more over a 20-year average. That number, the moment you reduce 20 to 15, 15 to 10, 10 to 5, becomes less and less and less and less. So the 20-year mark will save most investors, even those who make some subpar decisions. But in the short term, if you do want to increase assets, number of assets, you need equity. Can't just save your way through it. And that's where timing does help and reduces opportunity cost.
Good point. And obviously, start of COVID, or I would say October 2020, it was an interesting time. No one knew what was happening. And if you got in then, it's actually, you're obviously reaping the rewards now. And that was obviously compounded by ultra low rates. Rates we're not going to see again for some time. 1.79, 1.89. Clients are still emailing me back on an email I sent 2 years ago. Are these still available? No, they're not. So my question is, we're seeing the RBA make the recent decision of 2.85 cash rate yesterday, potentially going up until Christmas, maybe leaving it at 3.5 or holding off till early next year. Are rising rates a good thing for property investors?
Look, it isn't in the short term, right? Because remember, we have to firstly look back to purpose of rising rates and what the tool is that's being used by the RBO. In fact, their only tool really being used by them to, play the balancing game of inflation and interest rate movements is what they're using to enable that. Now, inflation and economy are the two things that they're trying to find the balance between. When you look at many of these inflation data points, though, and they've been stubborn, they've been high, so much of it has to do with a supply side, and B, an actual pricing of the goods, not so much the heightened level of demand for those goods. And so I still believe that, yes, there is a component, obviously, of purchasing power that will have lag and that will obviously show up in next year's data that has been tamed to some extent by some of the interest rate rises. But there is still so much sitting there that is not going to be cured by simply dialing up interest rates. And that comes with global supply. It comes with, some of the prices of the goods that are in the CPI basket. Now, coming to property investing, this is where rates and flow of money does make a macro impact. Very few people in Australia buy properties with cash, right? Majority of people who are buying properties are using lending to an extent. And the way that lending's been set up in recent times with the rolling assessment rates, and you know this really well, Cullen, is that it's obviously moved in line with these rate changes. And so what that's meant is that we've seen borrowing capacity reduction in the vicinity of 20 to 30%. And that itself is moving faster than prices are. So the price declines are still more mild than borrowing capacity declines, which means the credit that people need to buy on a macro level is impacting. And this partially explains why affordable markets are remaining quite well intact, because they still are available from that access to credit in many areas. Now,
Good
when it
point.
comes to, what we're seeing, though, is that there is a bit of overstatement in the impact of interest rates, massive overstatement. And why I want to put this into context is there are 10.7 million dwellings in Australia. Over the years of, we'll call it super, super cheap money between 2019, 2020 to 2022, it's about 2 years worth of transactions that occurred. And those 2 years represent an average of about 5 to 550K per annum in transactions.
Yes.
Those together, that equates to about 10% of market cap that has seen their first attempt or only attempts of buying during that period have a extremely low 1 or 2 starting interest rate. And so that does mean that 90% of other dwellings that exist in the country only had the low interest rate environment in the means of them holding their debts, not in the means of them transacting on property, which means that it is overblown and out of proportion in terms of the headlines that are out there for how much distress or how much impact these rates are having, because only 10% of take up when it comes to transactional changes of 10.7 million dwellings occurred during the super, super low rate environment. Yes, there are many others who benefited from the low rate environment, but very few people in the overall scheme of Australian dwellings actually transacted on housing buy or sale in terms of the total makeup of stock in Australia during those 2 years. And that's what gets overstated. 10% is the number. That's the number of total transactional impact.
Interesting. So by extension, and I don't want to put words in your mouth, Arjun, but when Governor Philip Lowe, God bless him, says rising interest rates will curb inflation and the spending that's happening, because there's only so much of the population that has a mortgage, do you think the rising rates have as big of an impact that the Financial Review and the RBA are making out?
It'll have less impact this time around in comparison to the past. And the big reason is remember, pre this rate increase, most of the country was locked up, and
Yes.
we had unfortunate times. Many lives were impacted globally,
Many.
whether it be deaths or whether it be job losses, whether it be lost time with loved ones and family. The truth is, people are feeling like they need to catch up on lost times. Some call it revenge spending. Some call it just whatever was paused, whatever happened during those 2 years was paused, and so they just condensed it into now. And catching up on good times with friends, restaurants, dinners, all that sort of stuff is playing against, I guess, the behavior that they want to see the interest rates do. And secondly, when that much money was input into the system, this much infrastructure pipeline is in play, it also gave many business owners a sense of confidence to grow. And they were also, the economy with such improvements has seen such low unemployment rates that sets up an opportunity for many to be in certain jobs, to earn more. Although the earning hasn't fully translated yet to data, all of these things mean that the interest rate push up has a little bit of stubbornness because of these different things occurring. And so I just think on top of that, it might take a little bit longer for them to see that transactional shift in behavior, although it will start to show up in the data. Now, the problem I have, though, is that even if it starts to show up in the data, there's still many global supply things that need to calm down, which will and is on trend too, from what we can see. And all of these things come together to create some of these changes in the inflation data set. And we can't forget the rents. The rents play a key part as well in this data set, and they are booming. So there's a lot of attachments to that overall data that they're looking at that A, has lag, but B, has things that the interest rate movement just simply can't tame. So I think there's a component of we'll need to watch, and hopefully they don't keep driving blind, only because I do have a sense of them overshooting it, in my opinion. And this is what some pullback is predicted to occur in 2023, and if not, 2024.
It's a good point. And in this market, obviously, it's a different market now, and agents are having to earn their stripes, as it were, in this market. They could open the door 1 or 2 years ago and it'd sell. What are 3 top tips that agents won't tell you in this market that you are telling your clients?
Yeah, so from a buying perspective, the top 3 tips that we're really giving out is, number 1 is, irrespective of what the agent says, we need to stick to our comparable value range. The property investing game, it'll always have some emotion to it, even though we try to say there's no emotion, we've got to keep it out. Yes, we do have to do that, but the buyer's going to fall in love with some properties. And my biggest tip for them is that, hey, if you set a comparable range going into it, the agent's job is to get the best range from you. And remember, you are investing here, and this is going to help you a lot. So sticking to ranges before the deal. Number 2 tip is that still broaden your horizon of markets. in this time, if you think everything is declining, it means that you are also probably only looking at one of a few major cities. The truth is, there are still many cities across Australia seeing healthy sales volume levels, declining days on market, low supply levels, but it just doesn't have the same level of intensity as we did last year, which represents 20+% growth, which you don't need to create a successful property investment portfolio. Remember, most portfolio planning, whether it be financial planners, property advisors, or anything, it ranges between 5 to 8% growth rates that are used. The last growth rates that we saw were in the vicinity of 15 to 30%. There's no financial planner out there, and I hope there's no financial planner out there putting 15% per annum on a modeling for their clients. And so the fact that they're not doing that and you're still reaching goals and creating outcomes that you want to see, you shouldn't be investing for the hope to see that 20% every single year. And that's why when you are in this market, don't think of just your backyard. Think broad to maximize the chances that you have to get that right asset in your portfolio. And the final tip is that when it comes to, operating during these times, there's going to be many voices. This is the same many voices that were there 2 years ago during the pandemic. Different time, same voices. Don't invest. Watch for this. Watch for that. I very quickly learned that our clock on this earth is very limited. The impact that we can make for ourselves, the impact that we can make for families or those around us. If you feel investing needs to be a part of your journey to do that, which most do, every day, month, year that goes by is more growth percentage that you need in a shorter period of time. And the odds are stacked against you the higher you dial the percentage requirements up, because you can't expect everything to indefinitely outperform. I want the odds in my favor, which means if I have a 20 to 30 year window, the odds are in my favor. Almost 90% of LGAs did really well over the 20-year period. So that's kind of my 3 biggest tips. Do not feed into the many voices is the final one.
I think that's, endeared by 2 points of what you're saying, everything, but 2 main points there, Arjun. I'll start with the second point. Taking advice from those that on the journey that haven't left home is not wise. Most of the people that are giving you that advice have never invested themselves. So I love that. And the first point, I'm a big Hunger Games fan. May the odds be ever in your favor. So Peppy says hello. So Peppy is from Balance Family Law in Canberra. She's a rock star. She's just been nominated in Women in Law. So she's saying hello to you. We got Mina, a regular of the show, saying hello. And we've got my doppelganger, Cullen, calling you a rock star, Arjun. I would say Arjun's only got like 5 to 7 minutes left. If you've got any questions, put them in now. It's now 2:15 Adelaide time, 2:45 Sydney time. Please, you don't have this man here very often. Put your questions, keep them evergreen in the comments, and I'll aim to ask them in the last 1-2 minutes. My question to you, Arjun, which I know from personal experience and the experience of my clients, what makes InvestorKit different? And how can you explain to a client who's paying a fixed fee that they're getting value for the time that you're putting in on their behalf?
Yeah, so the biggest difference for us has been a track record of outperformance. And so when we looked at the last 3 years of bank valuations for purchases, and we considered the boom that existed, we aren't going to say we did well, because everyone did well. But over that did well period, ABS reported Australia's house price growing by 41%. Now, during that period, we saw 29 to 49% in outperformance via bank valuations, depending on which year you took. And so that means if we're seeing a minimum of 29% in outperformance, we are proven and trusted to get results for our clients. And this is why 19 of the top 100 mortgage brokers use us. Many 7-figure sales agents and principals use us. Leading lawyers, bankers, and some of the top accountants in Australia personally use us. So I say the biggest difference is go where the pros go, because if they use us, I definitely feel that you'll benefit from it as well, and especially yourself, Cullen, as a valued client of ours and friend.
Look, I'm a big advocate of put your money where your mouth is, and I'd never recommend anything to my clients that I'm not willing to do myself, and I have done that. And as I said, one of our clients, we referred over to you on their first place, I think, or maybe it was their second place, I'm sorry. But since then, I think we're up to it's probably number 6 or 7 right now. It's just fantastic. So well done in what you do, Arjun. We've got a few questions. Mina's question is, what do you think of cryptocurrency in relation to property investing?
Yeah, so I'll be honest, Mina, in saying that I haven't dwelled down it too much. Now, in terms of what I think about just various parts of investing, I've been a big believer of nailing one before I go to the next. And so I don't actually advocate for diversity across 10 asset classes and 10 types of things, because it means you have 10 things to learn, 10 things to get better at, 10 more people in a team to add that are specialists in their own field, and 10 layers of conflicting advice. And so I'm a big believer of, once you feel you've nailed, and if that's crypto for you, Mina, nail it. Absolutely nail it. And then from there, you can kind of take the successes that work from there and the team learning, the team building that you've done, and apply it to different parts. And for me, it started with property. It's now in business and multiple businesses. And eventually I'll continue to do that. But for me, I think right now that's the biggest tip I can give on that crypto side.
That's a good point there, Arjun. Thanks for the question, Mina. And I will say, shout out to another leading legal figure on LinkedIn. His name is James Kwan. Not financial advice, but he has some interesting points on the subject of cryptocurrency. I would dare say follow him, Mina, James Kwan, Qian. And I think you'll get some tangible and meaningful insights there. And Piyush with the last question. Thank you, Piyush Handa says, great chat. If you could buy only one more property under 500,000, what would some top location options be?
Oh, tough one here. I would say, if we do a state by state tour, let me try and do a couple of states.
Come on, let's go.
All right, in Queensland, it's between Rockhampton, Townsville, Bundaberg, and Toowoomba. These four are just so close to each other. Rockhampton and Townsville offer obviously a lot more choices in that same budget. Both of them standing up pretty well. Just over the last couple of weeks, we saw multi-offer scenarios in some of these markets, all sold in the first open home. So that's clear demand. If we go to South Australia, Barossa Valley still continues to be an affordable option. And if we go over to New South Wales, Albury, Wagga Wagga, and Armidale, these three seem to be in that. And I'm talking houses here. That's why you're not seeing me say many of these major cities, only because I'd rather stick in some of these growing areas with a house than go for a unit, just because to be in a major city, I don't think that stacks up. If we go over to Victoria, data across Wodonga and also Shepparton continues to be pretty healthy. Parts of New South Wales, I forgot to mention, also Dubbo seems to be keeping on, even after having many years of growth. Look, there are many more states over there, but those are many locations to get stuck into. I guess it just shows that there's still affordability across many parts of Australia.
I love that. So please get onto that. Piyush, that was a fantastic question and a good brain scratcher there, but great answer, Arjun. And I know you've got to get onto your next meeting, but really value our time together today. Honor you as a friend. And where can anyone find you? Where are you most active, mon ami?
Well, you can also find me on LinkedIn, so Arjun Paliwal. And if you'd like to get a hand on starting or scaling your portfolio, we've got a team of 20 on our side here, and it's InvestorKit.com.au, and we're able to help, from first-time investors all the way to experienced and high net worth investors. And we often find bankers, lawyers, and small business owners are the most common clients that we typically work with.
Fantastic. So be sure to get onto investorkit.com.au. Thank you again, Arjun. Going back to the future. Enjoy the rest of your day in Adelaide. And thank you so much, everyone, Mina, Ayush, Papi, for asking your questions and tuning in.
Thank you so much. Take care.